Welcome, everybody, to Secret Sauce, the show where we hear real-time insights from industry leaders. I'm karly.iacono. Today, I am so excited to be joined by Brandon Isner, the head of retail research at CBRE Americas. Brandon, you are a wealth of retail knowledge. We are really excited to hear what you have to say. Welcome to the show. How are you?
I'm doing great, Karly. Thank you for having me. It's an honor to be here.
My pleasure. Now, we could just throw up graphs and talk about stats for, 8-10 hours, but we're not going to. We got to keep this condensed for our listeners. But everyone out there, just know there's more. There's always more retail information and research when you talk to Brandon Isner. So anything we don't cover today that you as a listener would love to hear about, reach out to me, reach out to Brandon, and we'll make sure you have the information that you want. Let's jump in. Brandon, start with your background and role at CBRE.
Sure. So, as Karly mentioned, I'm Brandon Isner. I'm the head of retail research for the Americas for CBRE. In September, it'll be my 10th year with the company. And I usually describe my time at the company as clawing and scraping my way up the ranks. I started as a researcher, and I liked research. I'm naturally curious about a lot of things, and so it's always been a natural fit for me. And so essentially, what I do is I assist brokers and different business lines with information and data, and sometimes I give presentations. I write reports, and basically just try to find the ins and outs of retail. And I usually tend to be on the side of I like to debunk what I general lazy thought sometimes, and so I focus on that a lot. But yeah, no, it's a great role for me. I'll keep it as long as CBRE wants to keep me in it. So it's been great.
I don't think anyone's going to let you go anywhere. So glad to hear you like it as well. And that might be one of my new favorite phrases: debunk lazy thoughts on retail. I like that. Whenever there's a contrarian perspective, that's a great way to put it. One of the main things we've been talking about from a positive point on retail over the last few years is rent growth. So let's talk about the reality of what retail rent growth looks like. I know we've seen a lot of growth because of inflation, but does that tell the full story? Is it inflation driven, or is it something more sustainable? What's your opinion?
Honestly, I think it's something more sustainable. Inflation always comes into everything, and it's gotten more expensive to run properties, and it's more expensive for tenant build outs, all those things. But really with retail, it's really at the very basic level, a supply and demand issue. And so, in the early 2000s and really through the mid and later 2000s, we saw this massive swell of retail construction. And a lot of it probably wasn't in line with supply and demand. A lot of it was probably over needed. And so that's when we started to hear a lot of that dialogue of the U.S. is over retailed. But really, since the great financial crisis, the level of new retail development has dropped off a cliff, essentially. And we've been below 1% of new supply every single year since the great financial crisis. And that's come at a time when, there's been expanding retailers. And so so this is one of my favorite stats. Over the last 3 years, new retail space delivered hit a new record low in each of the last 3 years. And we're going to hit another new record low in 2023. And that's come at a time when there's still a lot of demand. And so what's happened is we've achieved this place where we're in an all-time low of availability in retail at 4.8%. And so, it's supply and demand. So the best centers, the ones where everyone wants to be, they've really been able to push rents. And so it's kind of been, an advantage to the landlord over the last several years. And this isn't to say that, people always want to go, well, the mall near me has a lot of vacancy. Well, it probably always will if it's a Class C mall, and it's something that will probably need to be reinvested and redeveloped. But again, when that happens, that new space will go at a premium if it's a great property. And so, yeah, I'm not surprised to see the good rent growth, and especially again in the prime trade areas. It's really if you want to be in that area, which of course you do, you're going to pay the price, and it's going to be high.
So I think you hit on all the key points there. Limited construction, expanding retailers, supply and demand, basic metrics, right, which are pushing rents up. Do you have any stats or insight onto the construction, why the construction is so mitigated over the last few years? Is it cost driven in your mind? Is it lack of available space? Like, what's sort of driving that trend?
I think that, it's a lot of that. But a lot of it is due to the fear of this idea of e-commerce encroaching on brick and mortar retail. And but what we know now is that really, e-commerce isn't going to kill brick and mortar. In fact, that the two work together to make each other better. And so when you consider all these factors, and then now there was a REIT call that I was on recently, and they were talking about building out a junior anchor on one of their existing sites, and it was going to cost $300 a square foot to do it. And then they're talking about building out a multi-tenant pad site on one of their parking lots. And that was going to be $500 a square foot. And so what they said in the call is that there's only a few markets where they could even ask the rents that would make sense of that construction. And so you kind of hit on it too. It's also a construction cost issue, especially now. And will those costs regulate? I'm not sure. Labor costs are up. Materials have come down a little bit, but they're still high. So, so there's some people that we work with that say, I think we have all the retail space that we have right now. It's just a matter of, what are the centers that need reimagining or redesign or upgrades? So it's, I don't have a crystal ball, but it's, I think all those factors play a part in the lack of new construction. And I think that probably at least over the next few years, it's going to be a cost driven thing which keeps it low.
I agree. And it sounds like, of course, this is a negative for our developer clients trying to build new product, but
right.
For retail fundamentals overall, it really does bode well for rent stability over time, because the tenants are pushing, they're expanding. The tenants themselves are so healthy as businesses and companies, and they want to find space. So I do think that the lack of availability is making all of our centers and single tenant properties too even stronger. So great from that side, not so great if you're a developer, for sure.
Unfortunately, yes, I agree.
Yeah. Let's move on to another interesting topic, which is tertiary markets. So there's been a lot of population shift from the pandemic, and I would love to hear your thoughts on, was that temporary? Is everyone moving back to the cities, or are we seeing these secondary and even tertiary markets really fill out and take hold and become a different population base than they were a few years ago? And how do you think that affects retail real estate?
So I think it's more along the lines of that last point you made, where it just might be a new reality. And data wise, from 2019 to 2022, it's estimated that 62% of net migration within the U.S. went to tertiary markets. And that's significant when you consider that tertiary markets only make up about a third of the overall population. And now there's a lot of designations of what a tertiary market is. For the sake of my study, I took all MSAs over 4 million as the primary markets, all MSAs between 1 and 4 million as secondary, and then tertiary markets were all MSAs below 1 million. And so everybody might have their own definition, but so again, 62% went to these types of markets, and this is places like Bend, Oregon, and Coeur d'Alene, Idaho, and there's many others. And so I think a lot of people will stay in those markets. But that said, you hit on something else that was interesting about is this going to forever dent the larger cities? And actually, a lot of the big cities are coming back in a pretty big way. The legacy cities that the gateway markets that had trouble during the pandemic. I ran a set of stats recently for restaurant traffic for seated diners and restaurants, and a lot of those cities like New York, Chicago, Boston, they're all in around double-digit growth year over year in restaurant traffic across the first 7 months of this year. And so and a lot of the darlings of that time are starting to lose a little bit of momentum. And again, people always want to pit cities against each other, and I try not to do that. It doesn't have to be right or wrong or good or bad, but the death of those big cities, I think, has been way overblown, and people still love living there and will make those economic sacrifices to spend $4,000 a month on that one-bedroom apartment to live there. And so I think we're just in a situation now where everybody has the opportunity to work and live from their ideal set of standards. And I think it's great.
So Brandon, do you think that this population shift to the tertiary markets is moderating then, or are we seeing it? Do we think it's going to continue at the same pace that we've seen over the last few years?
I think both sides can be true. I think that we had a big swell of population go to these tertiary markets around the 3 years of the pandemic. Obviously the pandemic and the desire to distance had something to do with this, but again, I think that the financial part of it is a big issue. At some point, people might decide that paying $4,000 a month for a one-bedroom apartment is not what they want to do with their money. I think that there's a big shift. I think that we could see more of that, but I don't think it'll be as much of a shift as it was during the pandemic.
Prices certainly have not come down, but perhaps the pace of the migration will moderate a bit. I think that's my viewpoint on it. Now, with this shift to the secondary and tertiary markets, how are you seeing that play out through retail? Are you seeing increased demand from new tenants as vacancy levels change notably? Are we seeing rents increase more in those markets as compared to markets that are maybe more stable or losing population? Or has it not been that tangible of a shift yet because it's too new? What are you seeing data-wise?
On the rent side, I think it's not been quite tangible yet to answer that. But on an availability standpoint, tertiary markets, we again, since this is a hot topic, we went back and we labeled all of the markets that we track, secondary, tertiary, primary. And so we found that the tertiary markets, they've been outperforming secondary and primary markets in availability for the last few years. And outperforming, depending if you're a landlord, you like that. if you're a tenant, it's a little bit trickier to find space. And there's brands out there that are definitely seeking out these tertiary markets, even some of these rural markets, Starbucks and Chipotle, and there's a few others that are even developing kind of rural concepts that will fit into these types of areas because they see them as ripe for expansion.
I think that's so interesting because that's definitely a shift in brand strategy. I mean, it used to just be, okay, we have an area with very thin demographics. We know there's going to be a Dollar General. We know there's going to be a drugstore, hopefully a grocery store, and that's about it, right? And now we're seeing some of these really strong national brands focus on tertiary markets that before would not have even considered it, right? It would have just been an immediate nope. So I love this. I think it's great to see more involvement and more attention to new and upcoming areas from national brands.
Absolutely. And the interesting thing is too, is that, I don't have access to any data, but narratively, the tertiary market stores, they're cheaper to build out. They're cheaper to run. And a lot of times the performance is just as good as their primary market stores because there's less competition. And there's just more there's more excitement about that. If you're a national brand QSR and you open up on a corner of New York City, I don't think that there'll be as much buzz as if you open up in a town that you've never been before. And so especially as the drive-through has emerged as just such a big revenue driver for the QSRs, I think that's another aspect of it too, which these tertiary markets really lend toward that because a lot more people drive.
Mm-hmm. And I think because of all of this, sort of the stigma that tertiary equals risk is going away from the investor, from the landlord perspective. We're seeing a lot more demand, even focus on non-core markets from our clients. And I think that just shows you that the fundamentals are continuing to strengthen in areas that were looked at very differently even 5 years ago. So fascinating shift from our perspective too.
I agree, and there's something else that I don't hear much talk about, but I again, this is one of those where I don't really have any data to support it, but think about this. So there's been this big run on tertiary markets, and that data is tangible with population shifts, and so if you're an office investor, there's really not a lot of choices. There's not a great 30-story office tower in a lot of these tertiary markets. If you're a multifamily investor, there's not a great 25-story amenity-laden multifamily tower in these markets. But there's a great grocery-anchored center in every single city over 50,000 people. And if you think about that, the ability to spread your risk and to be able to enter these markets as a institutional investor, it's really interesting concept to think about. And I don't think it's happened really in the numbers yet, but I wouldn't be surprised if we saw, in just like you said, there's just this interest in these markets turning into actual movement in the market.
Mm-hmm. Mm-hmm. Yeah, I love that. It's a great perspective that it's really the only way to access the market in a lot of cases from an investment perspective. Good point. Let's shift gears a little bit and kind of circle back to retail sales, but with a different slant. So we've all seen the policies surrounding student loan payments, and those are going to kick back up end of this year, I believe, right? Is it October, September?
Well, they're October because my payments are due yet again. So
yeah.
After 2 weeks.
So, but that's a big number for a lot of people. I hope not for you, but that's a big number for a lot of people. Do you think the reinstatement of student loan payments will materially affect retail sales?
I mean, I think it has to. So I right before we jumped on, I did some last digging for data, and so the student loan balances right now, are you ready for this? $1.57 trillion.
Oh my goodness.
Student loans are out. $1.57 trillion. And so what I did a few months ago a couple months ago is I did a very rudimentary look at like what that debt service might look like. And so using very loose calculations based on the total student loan principal and average rate over time, which I put at 5%, and then using the average amount of time that people take to pay off a student loan, which is 10 years somehow. I'm in year 8 and I've only paid down about 20% of my balance. But using all those very loose assumptions, it's about $50 billion that goes into debt service payments every quarter.
Wow.
Now, if you look at the nominal growth in retail sales since those payments became optional, it's significant. And granted, that's not the only factor. Inflation's a factor. Right. Our friend Henry Chin in Hong Kong, he talks about the revenge retail factor, where people ran out and spend in restaurants because they were so fatigued from being locked down. But that said, I think that we would be unrealistic if we didn't think it was going to have some effect. And so we have our holiday trends report that comes out early every November, and we're actually looking into that considerably on how it might affect the holiday season. And we've had a couple great holiday seasons in a row. This could be the one that's finally kind of tripped up a little bit, because that is a significant portion of money that's coming due again. There's one report I think that said that it's $400 a month per person that goes out. Mm-hmm. I forget where that stat came from, but if you think about that, if someone makes $60,000 a year and pays $1,800 a month in their rent, and everything adds up, and that's before taxes, you don't the student loan debt service. It's a big number.
And do we think there'll be a lag effect? You mentioned it affecting holiday sales, so that's pretty quick, right? That's 2 months after payments start, roughly. Do we think we'll see it reflect in the numbers that quickly? This is speculative. Or do you think that it might take a while as people build debt and then say, okay, this is too much? So when will we really see the effect, in your opinion?
That's a good question. And I'm not an economist, but I think that's a fair statement to say that maybe this holiday season will be the last hurrah before
Right.
people kind of do lock down. And so, very, Richard Barkham, he's the head of our retail research, or the head of research for CBRE, and he's puts out a lot of reports on the economic uncertainty and whether will we see a recession, will we not see a recession, will it be a soft landing. And he uses the term economic uncertainty a lot, and I've taken that on too, because I think that we're just in such a bizarre economic climate right now, because yes, there is economic uncertainty, but over that same time, we've had very strong wage growth. We're still at very low unemployment rates, and households are actually in pretty good condition when you consider debt service payments to income ratio. It's actually pretty solid and below long-term averages. So it could be either. I don't want to put myself out there, but and I hate giving like the nebulous answer. But it could be either. But it will have an effect.
I think so too. And it like you just said, there's just competing factors here, right? Wage growth was still happening, although it sounds like it's moderating. Unemployment's still low, although that's slightly ticking up. All these things work together, and you can't look at any one thing in a silo, but it does seem like a material shift in spending power for a lot of Americans. So I'm sure you'll be keeping your eye on it and keeping us posted.
Oh, yes, definitely.
Let's go to another really hot topic that is forefront in my world of retail real estate, and that is the pending Rite Aid bankruptcy. What I think is interesting about this is this has been pending for a very long time, right? And then they did a rebranding. Then they sold a lot of their stores. There's been a lot of Rite Aid discussion for, gosh, I don't know, 9 years. It seems like, but this is big. This is real. So they're actually filing bankruptcy. I think there was something connected to the opioid lawsuits. We won't go too deep into that, but there are trigger points that look like this might be a really pivotal moment for Rite Aid. So if that's the case, and it all goes as it seems to be unfolding, that the brand may not exist in the way we know it, we'll see. What does that mean for all of their real estate? Do you expect to see the same fervor that we've seen around the Bed Bath & Beyond vacancies that have come up through their bankruptcy filing? Or do you think the demand picture will be a little bit different?
Well, you tell me, Karly. I mean, that's the secret sauce right there. You're the one with the tenants in the market. But seriously, yes, I think that I think that the real estate will have value. So drug retail is having a lot of troubles lately. There's this data set that S&P Global Market Intelligence does, where they it's this great study on percent chance of default by business type over the next 12 months. And for the most part, retail is in good shape. Default risk actually declined as of the most recent data, but drug retail is around. It's a little over 10% default risk, which is almost double the next highest type. So, I'm actually not surprised by the Rite Aid news. But that said, I think a lot of these sites will be highly sought after, right? QSRs. We talked about that a little bit ago. They can't get enough drive-throughs these days, and so a lot of these Rite Aids are on highly visible traffic corners, often with multiple exits and entrances. So they'll be great sites for QSRs. And you've probably seen the same thing. I've seen some incredible concept drawings out there for QSRs with the restaurant being elevated over a 3 drive-through concept, or at least a double drive-through concept. So I think a lot of these sites will get jumped on. What do you think?
Absolutely. I think it's going to depend very much on market and the competitive landscape, but I would expect Tractor Supply, discount stores, maybe even pickleball. Although I'm really tired of talking about pickleball. You never know. It seems to be popping up everywhere.
You told me I wasn't allowed to talk about pickleball.
I know. I said you weren't allowed to because I'm tired of it. But it's true. It's true. They might be appearing in Rite Aid. I mean, I wouldn't be surprised, right? It's kind of like the Spirit Halloween. It pops up everywhere. And that's how I'm starting to feel about pickleball. But in all seriousness, I think we don't No. But one thing we've noticed in retail overall is the flexibility of retailers that we haven't seen in the past because space is at such a premium. So just because the Rite Aid space or square footage does not fit a retailer's prototype or floor plan exactly, because it probably won't in a lot of cases, I don't think that necessarily means we won't see competitive bids on those spaces from retailers we're not expecting, because they are flexible and their prototypes sort of across the board right now. So I don't think we know everyone who's going to go after this space, but I do think that there'll be some interesting entrants into markets that where they couldn't get space before.
Your point about the pop-up market, I think you started to make. I think that could be interesting, because that's been talked about a lot. And in prep for our holiday trends report, I was asked about this yesterday, and they're asking about pop-ups, and it's like, look, I mean, the malls where the pop-ups actually went to be, there's no space.
There's no space, right?
And
not there. Yeah.
So maybe these pad sites or these sites right next to the Great Mall. Maybe that's the answer. That could be an interesting place for like these Christmas tree shops or whatever. Not the actual Christmas tree shop, but
right.
The holiday themed pop-ups. Maybe that is an opportunity for them.
In the interim, I think, right, until the final tenant is chosen. Yeah, it could definitely be a way to boost income in the interim.
Yeah, 100%.
Let's watch this unfold. It's another interesting one.
Yeah, for sure.
All right, I'm going to give you a free question. What is one misconception about retail that you hear all the time, and why is it just simply not true? Take it whatever direction you want.
That's like a softball right down
the middle. It is. Yeah, it's a gift.
It has to be that brick and mortar retail is dying. And I think I mentioned this earlier. I still hear this from time to time if I'm giving presentations, that people will be floored when I say that retail availability is at its lowest point ever. And especially from overseas investors, that's actually been really interesting. And this comes from, our product, our property type, it's heavily exposed to public perception, right? Because you and I, we could grab coffees and walk through a business district and look up at the office buildings and think, oh, that's a nice office building. But we really wouldn't have any idea of what's going on in that building. Same thing with a multifamily building. Oh, it's a beautiful building. What's the occupancy? Who knows? But if we walk through a street retail district, if we had no real estate knowledge whatsoever, we could see immediately vacant stores and have the idea that there's vacancy. And so I think that's why it's so exposed to public perception, and that can trickle into investors, I think, too. And so and that's one of my roles is like debunking that myth, is that no, space is really tight. And I know that you see it in your practice, and all our other colleagues I talk to around the country say the same thing.
Absolutely. And let's just dive into that a little bit further before we move on.
Sure.
What are you seeing in the e-commerce omni-channel retail? Are you seeing a lot of retailers, or do you follow retailers that once were e-commerce only? Are they opening stores? Are we seeing the blend? Like, how is e-commerce really affecting bricks and mortar retail, in your opinion?
There's a lot of brands that are expanding. The most famous, I think, are Warby Parker, obviously. Lululemon is another big one. Both those brands are exceptional at managing the multi-channel retail practice, because we still talk about omni-channel retail, and that word, it's like, I hope we can get rid of it soon, because it just means retailing, really.
Right.
Because there's a chart that I do that shows digitally influenced retail sales versus non-digitally influenced retail sales. And so digitally influenced became the dominant share back in 2016. And so that's people that are online researching the product, or maybe even research the product in store, but then buy it online. That happens a lot too. And we did our global consumer survey last year, and we found that of digital shoppers, people that prefer to shop online, that the majority prefer to return online orders in store. And then another very large segment of online shoppers prefer to try a product in store before purchasing online. So this idea that the store is irrelevant is ridiculous. And I think a lot of retailers know that, and especially going back to the question, I think especially a lot of these originally digitally native brands that have been able to build brand online, they understand the power of it, and then they can team up with people like our location intelligence division and find exact places that they should open stores. And so they're not going to be opening dozens of stores in a market for their first entry like was done in the 80s and 90s. They'll open key stores that they know that there are people that are online looking at their brand live in. And so they almost have an advantage to that because they can look at that data, they have the data, and they can maximize that to almost ensure store success.
That is such an interesting point, that the retailers already know where their consumers are because they can track where they're based when they're looking at the website. That's wild. It's true, but
100%.
Very, very interesting point. And I love your quote that omnichannel is retail. It's the same thing now. We don't have a distinction between bricks and mortar, digital, or omnichannel. It used to be 3 buckets. I think we do away with all of it because everything is basically omnichannel in some degree or fashion.
100%.
Love that.
Yeah.
Well said. Well said. All right, last question. What is a retail trend that you are very excited about moving forward?
So I mentioned earlier, I'm a city dweller. I always will be. And so I've always had a fascination with street retail districts. And the one I'm most interested in right now, and we're actually, again, this is another report that's within, that's in the works right now. The idea of emerging street retail districts. So we've heard a lot about news of some of the legacy high street districts being plagued by crime and slow sales, and most of these stories are completely overblown, by the way. But I've been making a point where I try to check out these fringe type emerging retail districts. When I travel and where an upstart luxury brand might be located between a beer garden and a tattoo shop. Right. It's something where it would have been unheard of 20 years ago, but they'll go and tattoos aren't inexpensive, by the way. So there's a lot of big spenders going into those places. But yeah, I think that's really fascinating. It's fun to see brands know who they are and have no fear whatsoever to go into a location like that. And it can be really exciting to also build your brand with the younger generation as well. And so I think it's a really smart move. And it's something we're seeing many times over in a lot of different markets.
So how are you defining this sort of high street or urban retail, whatever does it have to be walkable? Is it a certain population density? Like, how are you defining that kind of market?
So that's a great question, and this is where my arts background kind of helps me out. We have a designated set of prime retail districts that are legacy and go back many years, and we keep prime retail stats on that. And so that's one set, and then I just went around asking folks like where's the emerging district? Where do you get your coffee in the morning? And so, in places like, Miami and New York City and Chicago and LA and Boston and San Francisco, yes, San Francisco, there's really great emerging districts where all the news might be centered on one place. And it's like, well, yeah, but there's a lot going on over here that's getting missed. And so we ran this study on an index of occupancy, and the emerging districts are outperforming the legacy districts in occupancy, and not even that will be like a long-term thing. Again, it's just following the momentum right now. I think a lot of emerging luxury districts, there's probably lesser rents, there's more foot traffic, and again, younger people that might be walking around those areas that they want to identify with. And so, but yeah, so that it's kind of an it's a nebulous thing. It's not exactly one of those things you can officially define, but I think we could all figure it out. What those areas are like when it's where's the beer garden, where's the tattoo shop, right. Where's the best coffee shop, and where are local businesses able to start up and thrive and have that great organic clientele that they don't even necessarily need marketing because they're just great at what they do and they're located in that district. And you can find nodes of this throughout every city, and those are the kind of the areas that we're thinking about when we do run that study.
Those sound like sort of the hidden gems in every city that you would want to find when you're traveling, but wouldn't quite know where they were, and then would stumble upon it and be like, "Oh my gosh, this is amazing!"
Right.
So
Yeah. Exactly.
I think it's great. You're pulling them out, bringing them to the forefront, and sharing data for our clients and all of us at CBRE too, and keeping them on our radar. That's great. Thank you. Well, you have just so many reports, so much research, a lot of great data that we all rely on and appreciate very much. For everyone listening, we'll put up some links to Brandon's research and reports so you can dive in even deeper. But if you have questions on retail, feel free to reach out to either of us, and we're happy to answer them directly for you as well. Brandon, I know you're pulled a million directions. We really appreciate your time today. Thank you for joining us on the show.
Thank you, Karly. It's a lot of fun. Anytime.
To everyone listening, that was Secret Sauce. We appreciate you tuning in, and we will see you again very soon. Have a great day, everyone.